Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
You know, every business owner counts on deducting interest from their loans to manage their tax bill. It's just fundamental. But what if I told you the IRS has a rule that can just disallow a huge chunk of that deduction? Well, it's real. It's called Section 163J, and believe me, it's catching more and more businesses by surprise. So today, we're going to demystify it and figure out exactly what it means for you. So let's just ask it straight up. Can your business actually write off all of its interest expense? You know, for a lot of businesses, especially if you've been growing fast or you're in an industry that needs a lot of equipment, the answer is a surprising no. And this isn't some rule just for massive corporations. It can seriously hit your bottom line. Let's get into it. All right, here's our game plan. First, we're going to talk about what this interest limit even is. Then we'll hit the big one. Does this rule even apply to you? After that, we'll crunch some numbers and see how the limit is calculated. Look at why this rule has been such a moving target. And finally, we'll cover the silver lining. What happens to the interest you can't deduct right away? Okay, let's dive into Section 1. We're going to get right to the heart of it. What in the world is Section 163J? Think of it like this. The IRS basically wants to see that your business is earning enough money to justify its debt. So Section 163J says, hey, your interest deduction can't be way out of proportion with your actual profit. It's not trying to completely eliminate the deduction, it's just putting a cap on it, tying it directly to how much your business is earning. Now for the question I'm sure is on everybody's mind. Do I really need to worry about this? Well, the good news is there are a few major ways out. Let's see if you can sidestep this whole thing. The biggest, most common escape hatch is the small business exemption. But as you probably know, the IRS has its own very specific definition of small, and it all comes down to something called the gross receipts test. Now, this is a really important detail. The IRS isn't just looking at how you did last year. They look at your average revenue over the last 3 years, and that's a huge deal. It means one fantastic year won't suddenly throw you into this mess. It's your consistent performance that really matters here. And here it is. The magic number for the 2025 tax year is $31 million. If your 3-year average is under that, you're generally in the clear. Now, you got to remember, this number gets adjusted for inflation. It was $30 million for 2024, so you can bet it's going to change again in the future. So beyond that small business test, there are a few other specific exemptions. If you're an employee or a regulated utility, you're automatically out. But, and this is a big but, for farming and real estate businesses, it's totally different. You're not automatically exempt. You actually have to choose to opt out of the rule. And that choice, it's usually permanent. Which brings us to this really critical trade-off. You might be asking, well, why wouldn't every farm or real estate business just opt out? Because there's a serious string attached. If you make that election, yes, you get to deduct all of your interest, but you have to give up one of the best tax breaks out there, accelerated depreciation. You're forced onto a much slower schedule, meaning you write off your assets over a much longer time. It's a huge strategic call. Okay, so let's say you're not exempt. Now what? It's time to look at the math. And I know it sounds scary, but it's really just a simple 3-part formula. Let's break it down into easy pieces. So your total deduction for the year is just the sum of these 3 things. You get to deduct all of your business interest income, all of your floor plan financing interest, and then 30% of this thing called adjusted taxable income. All right, the first part is super straightforward. If your business earns any interest, say from a savings account or maybe a loan you gave someone, that income basically gives you a dollar-for-dollar credit to deduct your own interest expense. It's a simple offset. And now we get to ATI, which is probably the trickiest part of this whole thing. The easiest way to think about it is that it's kind of like your EBITDA. It's a measure of your operating profit before some of those big non-cash expenses. You start with your normal taxable income, then you add certain things back. And as we're going to see in a minute, the rules for what you can add back have been changing a lot. The third piece here is really specific. It's pretty much designed for businesses like car dealerships, boat dealers, you know, that kind of thing. If you have a loan that's specifically to finance the inventory you have sitting on the lot, and that loan is secured by the inventory itself, the interest on that floor plan loan gets special treatment and is fully deductible. You know, one of the reasons this rule causes so many headaches is that it just won't sit still. Congress has gone back and changed it multiple times in just the past few years, which makes planning a real challenge. This whole thing got a massive overhaul back in 2017. That's when it suddenly started impacting way more businesses. Then, during the pandemic, the CARES Act gave everyone a temporary break by bumping the limit up from 30% to 50%. But then, from 2022 through 2024, the rule got a lot tougher because you couldn't add back depreciation anymore, which crushed the deduction limit for a lot of companies. And now, starting in 2025, the pendulum is swinging back again. See what I mean? This constant change is exactly why you can't just set it and forget it.
So after all that, what happens if your interest expense is still over the limit? Does that deduction just disappear into thin air? Thankfully, no.
This is the final piece of the puzzle, and it's a big one. What is the fate of all that interest that gets disallowed? And here is the good news. The IRS doesn't just make that deduction vanish. Any interest you can't deduct this year gets carried forward to next year. It's like it goes into a little holding account, and you get to try and deduct it again in the future. And the best part? You can carry it forward indefinitely. There's no time limit.
So the most important thing to remember is this. The deduction is deferred, it's not permanently lost. But, and this is key, when you try to use that carried forward amount next year, you have to run the whole calculation again. It gets added to your new interest expense, and everything is still subject to next year's limit.
As you can see, Section 163J isn't just about filling out a form correctly. It's a major strategic factor. It impacts how you finance your growth, when you buy new equipment. I mean, it's a big deal. And with the rules always changing, the real question isn't just, am I compliant today? It's, is my financial strategy tough enough to handle the changes that are definitely coming tomorrow? Now, that's a conversation worth having.